think it's fair to say that the market is pricing a certain degree or pretty high degree of uncertainty still. To some extent, the steepening of the curve is a reflection of the higher probability associated in the polls to a Biden victory. Obviously, it's not just about the president; it's also about Congress and whether there's going to be a clean sweep or there's going to be a divided Congress. However, if you look at the broader picture within fixed income, it does look like some parts of fixed income, a big part of fixed income, is kind of anesthetized from what's going on on the political side and on the economic side. With whilst we have seen a steepening of the curve in treasuries, yields have been more or less in check or held in check by the Federal Reserve. And at the same time, in credit, spreads have had a bit of a widening at the end of the month because of the news around the elections and the rising COVID cases. But that has already retraced in the last few days.
Andrea, I was having a conversation before with a guest from JP Morgan who's saying 60 to 70% of a blue wave is now being priced into the market, which means you'd have to see more of a reaction if we did see that. And I think the thinking has just been quite extraordinary in a very short period of time, that if there is a unified control of Washington by the Democrats, that you would see this slightly more inflationary or recovery, stronger recovery picture taking place. What does that mean for the potential for yields to move further from here on that Treasury curve if it is a blue sweep come election day?
Well, both sides will want to have some sort of stimulus coming through eventually. Now, the impact is likely to be felt more on inflation-linked bonds, for example, where break-evens, so the expectations of inflation that priced in by the market have already risen. Should we see some form of stimulus coming through by either party, this is likely to continue. Although one has to bear in mind that a big chunk of some of the stimulus that has been put forward, such as loan guarantees, for example, hasn't actually been used in full. So it may be more a question of the impact on sentiment rather than the impact on hard data in the immediate aftermath of an announcement. For nominal yields instead, whilst there is a risk of volatility there, we do think that the Fed's actions through their QE program will keep nominal yields in check and keeping real yields in negative territory, just because the amount of debt that is outstanding out there at the moment, both on the government balance sheet and the corporate balance sheet, is such that we just can't afford too high yields. Because higher yields is higher interest and more money being spent there rather than consumed or invested. So the Fed will make sure that the yields stay controlled.